Hello everyone. Welcome to episode 15 of the 11FS Newsroom. My name is Adam Davis. In this weekly show, we take a deep dive into the biggest news stories of the week just gone. Don't forget to give us a follow on LinkedIn so you never miss an episode. Before we start, have you ever wondered how banks make money or what banking as a service really means? Our experts answer some of your biggest questions in our 11FS Explores video series. Finance can be confusing, but we think visualizing the problem helps. That's exactly what we do with the help of a light board. So check out the full 11FS Explores playlist today at http://bit.ly/11FS Explores. Today, we are talking about the Gamestop Saga. And for those of you who haven't kept up, here is a pretty short summary anyway of what's happened. So GameStop, if you don't know, is a video game retailer in the US. Think Blockbuster from many years ago here in the UK. It's been in decline for several years, pretty much like Blockbuster. And on January the 4th, the stock had been worth around $17. The highest the stock had ever been prior to that was around the $50 mark, which was in 2015 time. On January the 11th, Ryan Cohen, who's the founder of Chewy, which is a e-com pet food company, who sold out actually for about $3.5 billion. He joined the GameStop's board after his investment firm built up a 10% stake in the company. At this point, retail investors, especially those on the subreddit Wall Street Bets, went pretty crazy, and they potentially colluded together and caused the stock of GameStop to rocket 50% in a day, giving it a market value of around $4.5 billion. Since then, it's been fluctuating massively. It's currently dropped 50% today, which is just an enormous move on any stock on the market. It's now worth about $112. It did reach $347 last week, which is just a crazy amount, which means at one point it had a market valuation of over $20 billion. Which is just an incredible amount considering its past history. Some hedge funds have been shorting the stock. This was prior to this action taking place last week. When GameStop looked slightly dead and buried as a business. And since the recent trading activity from the retail and the Reddit investors, it has forced obviously the price up and has resulted in a lot of the hedge funds going out of pocket in something called a short squeeze, which we'll come on to in a minute. These events have had big ramifications with investment apps such as Free Trade and Robinhood or having to restrict access to either purchasing or selling the stocks. Today, Revolut's actually cap trading in GameStop and AMC. Drive Wealth is their underlying provider. Free Trade did that on Friday. CMC Markets limited short positions with that was I think on Friday over the weekend. IG has also done the same thing. So lots and lots going on, and it's a story which is continuing to play out. Joining me further to talk about this is Emily Nicolle, who's the Fintech Correspondent at Financial News. Emily, how are you doing?
I'm doing okay. I hope my Wi-Fi holds out for our conversation, so apologies if I go a bit pixelated. But
that's no worries. You're in and out, but you're in at the moment, which is the good thing. Lots and lots going on this story. I mean, there's quite a there's kind of the obvious, and then there's kind of like the undertone of like what's going on in retail investing full stop, which we'll come on to in a sec. Just to anyone who's listening, as always, we love getting your questions, so please leave them in the comments sidebar, and we'll be answering them for you live on the show. So let's get straight into it. What was your first reaction when you saw GameStop prices skyrocket? Was it like, damn, I haven't invested?
I mean, not for me. I don't think I'm probably allowed to invest in anything specific.
This is true. Well clarified. Well clarified.
Yeah, but I think I honestly didn't expect it to last this long. I did figure that the kind of meme stock craze would kind of die down a little bit eventually, and I mean, you could take the falls today and yesterday as a sign of that, of retail investors and now kind of hit their cap and they can't really pile in as heavily as they were before. But it fell last week as well. It fell on Thursday around about the same amount, and then went right back up again. So it's always fluctuating now somewhere between 100 and 350 about for the GameStop share price. So yeah, I'm not too sure what's going to happen next, but I'm intrigued.
Yeah, it's definitely people trading the swings. And I suppose who's speaking of people trading the swings, who stands to lose the most here? So there's lots of different parties. There's obviously the retail. There's your average retail. Well, so first of all, there's those on the subreddit who actually, I guess, colluded to do this market manipulation in some way. Then there's obviously the hedge funds who we can talk about, and some of them who had significant short positions against this company in the first place. Then there's the actual the investment providers, the platform providers like the Robin Hoods of this world, and then it's Joe Schmo investor who's just seen a headline and thought, "Cool, I'll have a bit of that." After they've seen that this stock has gone up, sort of 1,600% in a few weeks, and have thought, "I'm going to pile in." Who out of those four, I guess, are you most concerned for? I mean, it's a bit of a trick question, but
yeah, I mean, I think it'd be somewhere between like the Redditors and the Joe Schmo. Like, obviously, the Joe Schmo is probably the one that's most stands to lose. I think a hedge fund lobby group yesterday sent around a memo to internal members saying, you might be looking at these Reddit traders and clapping with glee that they're going to lose all their money, but it's probably about 80% of them will make a loss on one of these bets. So that kind of has to be kept in mind when we're talking about it, because you're right. There's the people who will just see what's going on and think, oh, maybe I don't want to miss out. I don't want this to be another Apple. I better get a share now, if they can. But I mean, even if you go on Robinhood, you're only allowed to buy one share in GameStop at the moment. That's your cap. You can have one, you can sell one, but you can only have one total. So I guess the providers are in themselves trying to limit it as much as possible. And you might be thinking that providers like Robinhood are also not going to do so well because their image is really taking a bit of a hit right now because of the caps they're having to put on traders. But on the other side of that, they're making a lot of money.
Yeah,
like Robinhood might be commission-free trading, but it makes its money in other ways, as we're well aware. So like, just because their image might be taking a hit, their user base is going to be so big by the end of this, and most people would now become more comfortable with things like day trading. It really, this democratization of the trading process is so big. They're definitely probably going to be the ones that come out on top here.
Yeah.
I actually haven't seen though what GameStop's response to it is. It must be somewhere, but I haven't seen it yet. So
I think they've probably passed out. They probably passed out at some point on like Monday last week when they couldn't believe what was happening. But yeah, you are right. I haven't actually seen any PR or press publication from them. Just on that point about Robinhood, it's amazing. Given all the press that's happening at the moment, their application was still downloaded over 600,000 times on Friday, which is generally more than, let's say, Charles Schwab, Fidelity, and other sort of big investment providers are downloaded in a month. 600,000 in a day. That's a crazy amount.
They were #1 on the App Store last week, and I think the CEO Vlad Tenev said they were about the same on Google Play as well. So the app is being downloaded a lot. That doesn't necessarily mean trades are happening, but people are downloading and having a look.
Yeah, exactly that. And I suppose I guess what's fueled this, because there's I mean, look, aside from the actual the event that's happened obviously last week, there's a general trend of, and there has been over the past sort of year or so since lockdown actually, of people investing more and more money. And there's a lot of people are pointing to the stimulus and the economic situation in the US, which basically has meant that actually savings have sort of gone up to a record amount at the moment, especially over sort of the last 9 months. People generally are sitting on more money without an ability to spend it, so people have sort of turned to the markets. And I suppose from your perspective, what are some of the, I mean, obviously aside from last week, what are some of the, I guess, implications of this? And do you think that actually people are getting in over their head by, potentially becoming DIY investors?
I mean, I'd say, like, on the whole, I'm probably more positive on it, and I think the implications mean that, as I said before, a lot more people will become comfortable with the idea of day trading. I know personally when I'm going on social media on things like TikTok, which is obviously I'm only 26, so my age bracket is in the younger end. And the amount of people who are using words that I only really learned what they were about a year or a half ago, and I'm a financial journalist, like people's understanding of how the stock market works, how investing works, all the different words you need to use, how short selling works, this is all skyrocketing. And that might mean that because of something like this, we have a group of millennials and Gen Z investors who are now about to start thinking seriously about things like building a portfolio, or even just like dabbling here and there and thinking more about how they can maximize their savings, which we never really had before. But on the other hand, because it's this momentum behind a few select companies and the extreme volatile trading that we're seeing, a lot of people will go into this buying a share at a certain price, might end up losing quite a lot of money on that, but they won't necessarily think that's a bad thing because they went into it with this idea like, oh, well, I'm jumping on the bandwagon, to the moon, hold on for dear life, YOLO, like all the different terms they're using on Reddit at the moment to describe everybody piling in. And so to them, it's a game, right? There's about maybe $100 in it that you might lose, but it was worth it for the fun of it. And then if we then try and translate that into other stocks and real world investing, they might then be thinking hard. They might not think hard enough about what that could mean for future savings, and if they start putting in more money elsewhere.
Yeah, it's interesting. The Goldman Sachs came out with a few stats across the last 24 hours. They said that checking deposits last year has grown by nearly 4 trillion in the US, and savings grew by 5 trillion. And on top of this, their economists expect more than 1 trillion in additional fiscal support in coming months into the US. I mean, there's a lot of money swirling around. I mean, look, we've seen it actually from valuations of some of the biggest tech companies have absolutely ballooned. And as much as you could say tech companies and tech stocks, that's a direct correlation to the lockdown. Simultaneously, there's been a lot of money that's been pumped into the economy, which has obviously had its effect as well. Talking a little bit about Wall Street Bets in itself, the subreddit community and other communities, what's your kind of take on that? And I suppose from their perspective, all they're doing is sort of is fighting back to the the hedge funds who take these short positions in the first place. And there's some figures on Twitter and in the public eye who are vehemently against shorting stocks. Obviously, Elon Musk being one of those, and his Tesla stock was incredibly shorted before it's sort of performed a squeeze on a lot of different venture hedge funds who have held those positions before. What's your feeling on those communities, and I suppose where they fit in the ecosystem versus hedge funds?
Yeah, I mean, you've actually just reminded me of last year or the year before when Tesla shorts were so high. Elon started selling a pair of shorts to kind of like capitalize on the movement. But yeah, I mean, I think that there's kind of two sides to Wall Street Bets, and I don't think they ever really like how they're portrayed in the media, even when the coverage is relatively nice towards them. So I think the New York Times got called out by Wall Street Bets for using things like it's partly fueled by greed, partly fueled by just like frenzied trading and momentum, and wanting to feel like you're part of something. But you're right, there is this other side of it that is the democratization of trading, and what they saw was a company like GameStop, which had actually pretty decent financials, but it wasn't doing very well because of just the general climate and the way that we now consume things like video games and DVDs and stuff. And so they saw that it had good financials, and they saw Ryan Cohen's letter to the board before he became a board member about that. And there was one user who started this all, who I will use his other name on YouTube, which is Roaring Kitty, because on Wall Street Bets it's probably not safe for work. And he started going long into GameStop in September 2019 with a $50,000 bet. Fast forward to now, around about the time of probably like beginning of last week, that had grown to about 23 million, that bet, because of the amount of money that he'd been putting in and the push from other GameStop investors and Reddit growing that bubble. And so a lot of people on Wall Street Bets will see what they're doing as a way to get back at hedge funds for shorting companies that they saw as having solid financials, doing quite well, but nobody really wanted to take a chance on them. All these hedge funds were putting big short positions out on it, trying basically to capitalize off the demise of a company purely because of the way like media usage has changed. And that was what they were fighting back against. However, we think about other companies that they've picked now, people like AMC, BlackBerry, Nokia, Bed Bath & Beyond. I mean, some of these companies might be the same, but how much do we think that Redditors were really thinking about, okay, let's find more companies that have solid financials? Or were they thinking, let's find more companies that are popular short hedge fund targets? I know at least for us at Dow Jones, we've noticed that a lot more people looking at stories where we've written about, oh, this hedge fund shorted this stock. I wrote one, I think, in December about how Melvin Capital, actually, which is one of the big targets for Redditors in terms of hedge funds, had shorted a lot on CD Projekt Red, which is the developer of Cyberpunk 2077. And then that stock started to rise as well, even though it tanked loads in 2020 because Cyberpunk was so badly received. That has then since been rising again because Redditors are just going to any stock where they think it could hurt hedge funds if they go there. And so that's kind of what we're starting to see as well. But the motivations behind it differ.
Yeah, I mean, I noticed the price of silver's gone up. Apparently, that was one of their targets. I've got a couple of silver bracelets upstairs. I'm going to just pull out of the drawer. You never know. They've just, 35% on.
Silver's a really interesting one. It's been something that was kind of floated a little bit on the forums last week, but it wasn't necessarily something that was a major focus. And then now it's starting to really fall and rise, as with the other stocks. But silver is not a company, it's a commodity, it's a metal. And we have to start thinking about how much that might affect supply. Will it start to affect everyday items that we buy? Because silver is used in a lot of things, from medicines to building materials, solar energy, all that kind of stuff. And so that one is more slightly worrying because it has real world implications if you start making that stock very volatile.
Yeah, it's a good point. Just very quick. So Elon Musk yesterday used social media, Clubhouse, which is, again, I mean, we could have done a show about Clubhouse because it's been in the news so much over the last few days. But anyway,
we're on it tomorrow, I believe.
Yeah. Oh, yeah, we are quite right. Yeah, David and Jason, I think, are on it tomorrow. To conduct an interview with the Robinhood CEO Vlad Tenev after conspiracy theories flooded the social media. It's interesting to note that Robinhood have just pulled out a full-page advert in the New York Times today, sort of stating their position, which we'll come on to in a sec. In that interview with Elon Musk, he said that Robinhood had to restrict access to GameStop and other meme stocks, such as you say, AMC or BlackBerry, after his operations team received a file from the NSCC based on some factors, including the volatility of trading activity into certain securities. The NSCC is the National Securities Clearing Corporation. I had to write that down so I'd remember it word for word. What's your take on that? So, I mean, Robinhood said they had no choice but to restrict these stocks, as probably, and I think all the other providers have had different reasons, but virtually sort of circling around the same kind of reason. If there was a way to explain it for the regulars, how would you do that?
So I think what Vlad said when he was speaking to Elon yesterday was that essentially on Thursday morning at like 3 a.m. or something last week, they got a notice from the NSCC that said you need to put 3 billion more into your capital demands, and usually they'll get probably far less than that. But basically what's happening is that demand for buying stocks such as GameStop and AMC were coming to Robinhood, and people were saying, I want to buy this much in GameStop. And by Thursday, that had hit around the 3 billion mark. But Robinhood didn't have enough set aside to be able to basically safeguard those until they're able to settle the transactions, because people will put in a bid to buy a stock, and then there's about a 2-day period in which there could be some level of risk before they'll have a seller whose share will then go to that buyer, and Robinhood has to cover the risk in the meantime. So that's what the NSCC was trying to cover, basically saying you need to put up 3 billion more because you're not going to have enough to cover that risk.
Yeah.
But what happened in the meantime was that the Robinhood basically didn't have enough money. So they got them to come down to around 1.4 billion. And then they said, okay, and in order to cover that, we will stop people from buying so many shares at once. In these particular stocks that we've outlined is where all the boom is coming from, so that the other parts of their platform can operate as normal. But in these few select companies where there's extreme volatility and extreme risk, they can kind of mitigate their chances. But as a result of that as well, even just to cover the demand that they do have, they've had to raise an extra, was it 3.4 billion?
3.4.
Yeah, I mean, so just to keep Robinhood going and solvent.
It's amazing, isn't it? It's extraordinary sums of money, absolutely crazy sums of money. And I guess, but listening to that and understanding that this is a lot of this anyway is a force of the market and a force of the NSCC and others doing what they should do and making sure that Robinhood stays solvent, but also that that they're acting in a responsible manner. Do you think it's fair that of the criticism that they've received that's forced them to sort of take out this page advert in the New York Times to have to defend their position to retail investors?
Yeah, I mean, I think the criticism was leveled at the fact that they were limiting people from buying, but they weren't stopping people from selling. And they weren't, for example, stopping people from taking out short positions either. And so Redditors who are in this big push towards being able to democratize trading and get back at hedge funds and get more retail everyday investors involved in the stock market, they just see their chances being hurt and hedge funds not taking any of the hit. And that was where all these conspiracy theories started to come about hedge funds collaborating with regulators to put a stop to what they're doing, which of course only makes them want to buy more shares. But so I understand where Vlad was coming from, because he said, well, basically, if we decided to stop letting people sell shares too, we're hurting more people, and that's just categorically worse, is what he said. Which I guess, yeah, right, you're putting more people, like you're just upsetting more people if you do that, rather than if you just only limit one side of it. But I don't think there's a right answer to any of it. And as you said, we've seen brokers all take different variations of steps to see how they can protect themselves. So, I mean, they had to do something. You can't really tell them they didn't. So
exactly that. Just a little bit before we finish on sort of gamifying the stock market, I guess. And going forward, I suppose, what these kind of communities might mean to the stock market in the future. In your opinion, I mean, if you look at hedge funds, I suppose, and the concept of shorting stocks, this is, by the way, apparently, again, this was from Goldman Sachs. They say this has been the biggest shortest squeeze they've seen in over 25 years on a trailing 3-month period. So like an extraordinary time of volatility, especially over the last, let's say, 2-3 weeks. But in your perspective, in terms of the concept of shorting stocks in the first place and hedge funds' ability to do that versus, I mean, a lot of people have the ability to do that, but hedge funds can obviously do it in a better economics, versus, this kind of nouveau, community-based investing. Do you see... do you just see it all, I guess, as a continuation of a game, or the broadening of a game which the hedge funds have almost started, so they're getting their comeuppance? Or is this actually something which is should be stopped because it's actually a detrimental and not necessarily in line with, I guess, the status quo?
By which one do you mean should be stopped? Short selling or
no? Well, either, but I was referring more to the community-based, Reddit-based investments. But either, I'm interested to get your take.
Yeah, I think we have I think regulators are being posed with like a real big problem, because they've got, on the one hand, a very large movement of people saying short selling shouldn't be allowed. And we haven't just seen that from Redditors, we've also seen it from people like Alexandra Ocasio-Cortez, and even some big hedge fund managers as well have weighed in saying short selling goes against this idea of people being able to invest and go from nothing to something. And that's kind of what the idea of investing is, right? It's growing wealth. So should short selling be restricted in some way so that we can allow more people to grow their wealth, and have it become more of a community thing, as you said. But on the other side of that, we've also got hedge funds that view short selling as one of their tactics. It's one of the ways they make money. It's how they are able to do things like grow pension funds for teachers and for you and me. A lot of our pensions are being invested in things that are short bets, or in stocks like GameStop. Hopefully not all of it, but some of it's probably going in there. And so if we think about that side of things as well, regulators have to think, how do we not shock the market if we change things, and how do we make sure funds are being fully protected in that way as well?
We've got about 2 minutes left, so I'm going to do the outro, but I will just say, just before I do, that since we've been talking, GameStop has gone down another 10%. So there you go. It's now on $89. It's not a good day if you're an owner of, well, yeah, as many of you are probably, or possibly an owner of GameStop, down another 10% in the last 25 minutes. So there you go. It's coming to the end of the show. Thanks so much, Emily. That was great. A great explanation in terms of some of the underlying economics and issues at play. Where can people, I mean, you're on here all the time, so they could just, wait for the next time you pop up on FinTech Insiders. Yeah. But where can people find out more about you?
So you can read all my articles at Financial News, which is fnlondon.com, and you can find me on Twitter at Emily J. Nicolle.
Wicked. Thank you everyone else for joining us. To make sure you don't miss out in future, follow us on LinkedIn and on Twitter, and goodbye for now.